Hey, Cashflow Ninjas, real quick before we jump into today's episode. I've been asked by many people recently, what has been the one thing that has made all the difference on my journey as a business owner and investor? I started businesses and I've invested in businesses. I've invested in single family real estate, multifamily real estate. I still have a sizable portfolio of multifamily real estate, historic resorts, mobile home parks, oil and gas, life settlements, gold and silver, Bitcoin and cryptocurrencies. I could go on. But the one thing that has changed the financial trajectory for myself and my family has been infinite banking. Yes, you heard that correctly. That is the number one thing I've done over the past 2 decades that have made the single biggest difference. And it's not even close. Setting up and building out a family banking system using infinite banking has enabled me to create my own financial system. This year, it has allowed me to focus and not pay attention to all the chaos in the global economy and global financial markets. I really don't pay attention to all the noise about tariffs, trade wars, markets violently going down and then going back up, or interest rates skyrocketing and wrecking real estate deals and other alternative investment deals. Do not be beholden to other systems. Create your own system. If you're interested in working with me and my team at Producers Wealth to set up your own banking system or your own business and family banking system, then go to getwealthyforsure.com. That's getwealthyforsure.com. When you go to getwealthyforsure.com, you can request a free copy of my best-selling book, Get Wealthy for Sure. Only pay for shipping. You can also watch all of our presentations and schedule a call to explore infinite banking options with me and my team. You don't have to be powerless amidst the chaos. You too can have a financial strategy that provides certainty, predictability, and clarity. You and your family can also get wealthy for sure. Go to getwealthyforsure.com to start your journey today. The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Lobsher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Lobsher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. We have over 1,000 episodes, 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the best newsletter and the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I'm joined by August Biniaz. We're going to jump into real estate, look what's going on from a macro perspective in the world of real estate, where we are, how we got here, and what comes next. And then also have a discussion around multifamily real estate investing and also a very unique asset class that is a big, big trend now in real estate called build-to-rent single-family rentals. It is communities of single-family real estate. August, great to see you.
Thanks for having me. Nice to see you as well, my friend.
Yeah, great to connect. And I've been looking forward to our conversation. For my listeners and my viewers that's not familiar with you and what you do in your background, can you please share a little about your journey and background with them?
Yeah, of course. Currently, August Biniaz, I'm the Chief Investment Officer of CPI Capital. CPI Capital is a real estate private equity firm focused on U.S. real estate, particularly multifamily and BTR SFR, which I'm sure we're going to be getting into what that asset class that is. We're hyper focused on Florida and Texas as far as kind of our regional focus. What sets us really apart from other investment firms in the U.S. is that we started in Canada, so we have a lot of our investors initially came from Canada, so we have Canadian offices, but we also have offices in Florida. So when we syndicate a deal and bring it to our investors, we have both Canadian LPs and US LPs that are participating in these deals. That's a little bit about myself. Yeah, kind of. Would you like me to get into my background as well? How I got
Yeah,
here today?
your background and how you got involved in the business.
For sure. Yeah, I've always been a real estate guy. I've come from somewhat of a real estate family. My maternal grandfather was in real estate, was a broker, had his own brokerage. My mom was always very much involved in real estate. She was one of my first investors. When I was in my early 20s, figuring things out where I want to be in life, she suggested I get my real estate license. She said, it's pretty easy. You just get your license. People list their houses with you. You put it on this thing called MLS and they sell. It's just pretty simple business model. I'm like, all right, great. I got my real estate license, but it doesn't work out the same way as it is. I mean, it's a very competitive market. Only the top 1% of real estate agents really make it, and you got to make a career out of it. Marketing is a big part of that business. Being a real estate agent, I didn't really see a career to be a real estate agent, but I really felt that I could, as being an agent kind of allows you to have a pulse on the market. So got involved in actually doing small fix and flips. Would be the listing agent and buying agent on these things, and eventually started my own general contracting firm as well, because it was difficult bringing on GC. You're really at the mercy of the GC always when you're doing fix and flips. I moved on to actually building custom homes, custom and spec. Custom homes is where you build a custom home for a client to hire you as a builder. Spec is when you build a home and you put it on the market and trying to sell it for profit. So I was doing both of those strategies for close to a decade. My company, White Rhino Developments. I always wanted to scale. I wanted to do bigger projects. I wanted to maybe one day build a high rise. And I looked around, always kind of seeing, how are these high rises built? How are they funded? It was unfathomable to me because it was Vancouver had gone through a real estate boom, because a lot of people coming from China and other areas, they could get citizenship in Vancouver for in a very expedited way. Within 3 to 5 years, they could become a full citizen. And you had all these wealthy people coming to Vancouver. So real estate prices went on a bull run over the 20-year period from the late 90s to the late 2000s. It went up 500%. So both in Toronto and Vancouver. And I really saw the boom, not only on the single family side, but also on the high rise and mid rise projects. And I want to know how these projects were really put together. Never understood what GPLP was, never understood what funds or private equity was. Eventually, I had a deal that came across my desk as a single family home builder. It was a 5 single family lots that were, the city hall allowed you to rezone and build townhomes. We could build 20 townhomes. So I was really making money on the buy. What that meant is whoever had put this project on under contract, they had put down a $250,000 deposit. Another $250,000 deposit was due, but they had come to some financial hard time and they just wanted to sell their contract. They just wanted to get their 250, walk away. But we were making money on the buy, meaning the property was worth more than what it was in the contract. And we had a few months to come up with the other 250. So I took over the contract without having the money needed. It was an $8.7 million purchase. We probably needed at least half of that in equity to put up to buy the property. And I put it under contract, took over the contract. And now I had to go find the money. So I went to a few partners and friends, and we were able to close on the land, pay this guy out. He walked away. We got over the contract. And my pitch was, hey, we're making money on the buy. This place is worth well over close to $10 million. It's 8.7 right now. This guy just wants to walk away. And that was kind of the start, the impetus for me to get involved in putting deals together. And on that particular deal, I still didn't know how GPLP structure was. So we just put it in a corporation. We had shareholder agreements, and I was also an investor in the deal as well. But the agreement was that for me, bringing the deal to the group and sitting on the board and bringing all the advisors, I would get piece of the upside. I would get piece of the profits that we would make. I really fell in love with that model of finding the deal, bringing on the investors, bringing all the professionals, and getting a piece of the profits, like really a performance-based compensation. And that was kind of the start for me to go and figure out how am I going to do this on a larger scale. And most of the information I was gaining was coming from podcasts, YouTube shows such as this show right here. And most of the information was coming from the US. And that's what I learned about syndications, funds, how REITs work, and all the differences between that. And kind of that was kind of the start for me getting involved in the space I'm in now and co-founded CPI with a few great partners. And now we're here today.
Great. Let's take a look at real estate in general from a macro perspective, big picture. What are you seeing? Where are we today? What's going on? And how do we get here? And what comes next?
Of course. Yeah. Real estate really goes in cycles. And this is not me, August Biniaz, saying this. This is experts, economists, people who've been in real estate for decades. Real estate is cyclical. It comes in these cycles. So you got cycles, which is recession, which is the bottom of the market, really. Then you go through recovery, expansion, and hyper supply. So real estate constantly goes through these cycles, not always chronologically, but it just goes through these cycles over and over, depending on where the market is, depending on how the economy is doing, depending on where the inflation is, where the interest rates are at, where the Fed's funds rate is. And it does that consistently over the last 100 years and a bit. So today, I would say we're really in the phase of recovery. So we're coming out of that recession phase. What happened is through COVID, the central banks, including the Fed, had to print a bunch of money and basically deposit in people's accounts. And what happens when there's exuberance like that? It creates overspending and it creates inflation. So inflation in the U.S. went almost up to, it went to 9%, and that's not healthy by any means. Almost borderline with hyperinflation. And one of the ways that a Fed can fight inflation is one of the major ways is by increasing interest rates, by increasing the Fed's funds rate, and to slow down the economy. So the Fed increased its rates 11 consecutive times. It did a pause and increased it a bit more. So the Fed's funds rate went from 0 to 5.25 over a year-long period, which was a really shock to the economy, slowed a lot of things down, a lot of real estate, slowed it down because the debt price is so high and the deals are just not making sense. And people who had borrowed a bunch of money when there was a lot of cheap debt out there, they got themselves in trouble. Commercial real estate, in some cases residential as well, but mostly in commercial real estate, which multifamily falls under the same umbrella. And that created some distress in the market. We also had an issue with COVID. A lot of people were working from home. So under the commercial real estate umbrella, one of the asset classes is office. Office space is a very major asset class in commercial real estate. And with people not going back to the office, you had a lot of vacancy, you had a lot of distress in the office space, which caused an issue all over to the whole segment of real estate. And overall, those two effects, the high interest rates and the velocity of how the interest rates went up, and because of the office space, it created a big slowdown. So a lot of defaults, a lot of loans maturing that were secured in 2020. In 2023, those loans were coming to maturity because commercial loans are not like residential in the U.S., where there's a 30-year rate term. The term is usually 3 to 5 years, maybe sometimes 7 or 10, but mainly is 3 to 5 years. These bridge loans. So a lot of groups themselves found themselves in trouble, and now we're kind of in obviously 2025 or the loan maturities are coming down. A lot of development slowed down. And now where we are is really, if a real estate was a clock and 12 o'clock is the top of the market and 6 o'clock is the bottom of the market, myself and a lot of experts would say that today we're on between 6 and 7 o'clock. So we're at the bottom of the market coming up to go back up. So yeah, that's my quick description of where we are at, how we got here.
What are you also like seeing? Because there's a lot of cross-border investing. Like what and from a The Canadian markets, because I guess what I'm trying to say is there's a lot of Canadian investors. They live in a different real estate market than the United States. And maybe you can speak to that. How does that work to change the perspective and saying, hey, this is what's going on there. This might be your reality in the United States? Because you mentioned you guys started in Canada, have a ton of Canadian investors now doing deals in the United States. So how do you bring that together?
Yeah, no, of course. CPI, when it spawned, its mandate from day one was allowing Canadian investors to have exposure to U.S. real estate. So we never really done any Canadian deals under the CPI umbrella. But yeah, kind of as far as Canadian investors looking to invest in the U.S. has always been open for business. There's a treaty between Canada and the U.S. that allows Canadians to invest in the U.S. and not be double taxed. It exists for other countries as well. So, I mean, you have the number one capitalist country in the world, the U.S. So it's open for business. People can invest in the U.S. A lot of, and what brings most investors to the U.S. is yields. The yields that are available in the U.S. don't exist in Canada, in Germany, in other countries. That's why people come to the U.S. and that's why you have the flow of funds coming into the U.S. Really kind of in the modern day era of Canadians investing in the U.S. really started post GFC, with the subprime mortgage crisis in the U.S. and the U.S. economy going on in a distressed territory at that time. The U.S. dollar devaluated and it was at par with the Canadian dollar. And homes were pennies on the dollar. So a lot of Canadian investors started purchasing properties in the U.S. post GFC. This is on the retail side, people coming and buying a vacation home or buying a secondary home. But it's right around the same time, I would say between kind of like that 2008 and 2013, a lot of Canadian institutions started investing in the U.S. as well, utilizing same type of securities exemptions that exist in the U.S. where you can go to the members of the public and raise money. Canadian firms started raising money, and you had a huge flow of funds in the billions of dollars on an annual basis coming into the U.S. So we started a firm in 2019, 2020. Right around when COVID hit. So we've been kind of through a lot of ups and downs since then. But again, yeah, the idea was we're basically chasing yields. In some of Canada's major cities like Vancouver and Toronto, the investment psychology is really different. A lot of these, including institutions that are investing in these two cities, they're not really investing for cash flow. Most properties are not cash flowing. Cap rates are so compressed that the yields are not there. So the enthusiasm and the draw is always there for U.S. real estate because the cap rates are higher on a apples to apples on at par basis. The cap rates are higher in the U.S. when you compare the same property, like a multifamily 80s built property in Canada is trading at a 3 cap, when the same property in the U.S. is trading at a 6 cap. Same risk profile, but it's just a different economics that it provides to investors. So the draw has always been there. We use the same tax treaty that exists between Canada and the U.S. to put together project-specific feeder fund for our U.S. master fund. So we closed on a deal recently in San Antonio. It was a build-to-rent deal. Can kind of get into that, what build-to-rent is. But for that deal, we put together a U.S. master fund. The U.S. master fund owns the property, and all the U.S. investors invest directly into the U.S. master fund. And then we create a Canadian feeder fund, project specific, just for this project. That fund is there, and it's a feeder fund to the U.S. master fund. So the Canadian investors invest directly into the Canadian fund, U.S. investors invest directly to the U.S. fund, and then the Canadian fund invest into the U.S. fund just as alongside the other U.S. investors. That's how really we structure deals. And background about Canada and the U.S.
No, it's interesting, and I wanted to highlight that because sometimes, the perspective is great from the outside for U.S. people to hear. I being from South Africa, I always share with people too. You don't get deals of real estate or investments like you do in the United States, and especially the tax benefits. The tax code is very, very great for investors in the US. So sometimes it's funny when you're in the United States, you get people that they don't understand from an outside perspective how great and attractive it looks. And, now you bring in like geopolitical elements too, just moving away from Canada, the United States to Europe, right? Imagine you're in Europe right now and your investors and your private equity funds and and you're looking at where do I place my money now? Now, all of a sudden, you have uncertainty. You have a war already in the Ukraine. You look at all these tensions building up as far as like war. So, yeah, real estate probably not a good place to have when there's bombs falling out of the sky pretty soon, right? So, people I've been talking to have seen a flood of just an influx of European funds and money coming into the United States just because of the uncertainty that's there. So it's interesting how folks in the United States have a perspective that, oh, things are, a little bit, we don't know what's going on. And if you look at the news, any type of news channel, you are probably less informed than what you were before you looked at it. But it doesn't give you a happy, warm, and fuzzy feeling. And I'm always the one saying, look, the rest of the world, you have to see the perspective from the outside to see how attractive the United States still looks today.
They don't know how good they have it. I mean, even with the tax deferral 1031 exchange, you can defer your profits forever, right? Even at the time of your passing, you can kind of defer it, and your family doesn't have to end up paying taxes. But look at the boost in the economy that creates. You sell a property, all the gains you've made from it, you can actually defer to your next deal. So that kind of boosts the economy, kind of forces reinvestment and what have you. Tax rates as well. I mean, if you're outside of California and New York, the U.S. tax rates, Texas and Florida don't even have state income tax for those two states. There also, the other aspects are tenancy laws. So very landlord friendly states, Florida and Texas. In Canada, I mean, you're in a battle for months and years sometimes to kick out a tenant, whereas in the U.S. is a couple of weeks. I mean, it's mind blowing. And in Canada, I mean, particularly in Vancouver and BC, if you go into a rental agreement and you own a property, you put a rental agreement in place. When that lease term expires, is usually 12 months, you can't evict. You can't expire the lease. The lease is in place forever, and you have to have just cause for removal, and that cannot be renovation or anything else. It's mind blowing how this works, and you have to pay a penalty at 3 months of rent in the best case. But in the U.S., when the 12-month lease term expires, you can ask the tenant to remove themselves. Now, keep in mind there is situations when it comes to shoddy type of landlords, but when you're managing an institutional level multifamily deal, we have a deal in St. Petersburg, Tampa MSA, 136 units. You don't want to also be going in there and kicking out the grandma who's been living there for 12 years, paying a reduced price in rent because Google reviews are there. So you want to be strategic on who are you evicting, who's causing problems, what the demographic, but you also want to be cognizant of long-term tenants who paid, your rent on time and, whose family has been there. So, and that's where good asset management really comes in play.
Yeah, absolutely. You've mentioned Florida and Texas. Those are the markets that you guys operate in. Are there any other markets besides those two?
Those are our primary markets. We have a dual primary market approach, which is Florida and Texas. In Florida, we're hyper-focused on Tampa, the Tampa Bay MSA. And then in Texas, we're focused on San Antonio. It's an hour and 20 minutes from Austin. The prices are great. A lot of Fortune 500 companies there in both of these cities. So those are our primary cities.
Now, you had mentioned that you guys operated multifamily real estate, but you'd also shared this BTR SFR, built to rent, single family rentals, and it's communities of them. So listeners of the show and viewers are familiar with kind of turnkey single family real estate, right? But this trend of this BTR, built to rent, single family rental communities, is really taking off. Can you share more about that, what it is, how it works, and why it's so attractive?
Absolutely. Let's take a step back. So post GFC, we talked about GFC already, the subprime mortgage crisis that happened in 2008, and it resulted in a lot of foreclosure throughout the U.S. Now, Wall Street, they're smart enough to be as smart as August Biniaz to know real estate is cyclical. So they knew that they could buy single-family homes, swaths of these single-family homes as portfolios of these scattered single-family homes, buy them pennies on the dollar. And the business plan was just to wait till the market cycle changes and offload them. So they bought tens of thousands of homes, including firms like Blackstone's, like the big names that you hear. And simple business plan. But what they also did is, while they were buying tens of thousands of single family homes, they started actually managing them. And they realized that single family homes as a portfolio, they really manage and operate just like multifamily. So by 2013, when they could no longer buy homes on pennies on a dollar, they really liked this asset class. So they actually started partnering with local developers in Phoenix, in other markets, and they started building communities of single family homes for the purpose of rental. And that was really a spawn of this new asset class, BTR SFR, or known as build to rent BTR, really. And other groups, more of a boutique firms like us, are also getting involved. Now, the model is not only partnering with a local developer, building these community of single family homes and renting them out and holding them for depending on how long your business strategy is for. You could also purchase already built communities of single family homes straight from a developer who's built these, stabilized it, brought it up to 90% occupancy, and then sold it off to a institution like us or others. You could also buy an older community of single family homes, and the business plan is to go there and do some renovation. So there's different business models within it. But after all, it serves a certain demographic, people who want to live in a community of single family homes. At times when you go and rent a single family home, you're in a neighborhood where everybody else owns. You might be the only person renting, so it might create some stigma. People might not enjoy that, but now you're living in a single family community of other rentals. It also gives you the security of having a garage, your own personal garage, and access to the home. It gives you the convenience of not having somebody living above you, next to you. You get a backyard. So it has a lot of those conveniences. It's also great for the new generation in the U.S. The U.S. has over 100 million renters, and not all of them are in workforce living in multifamily. A lot of them are people who want to live in Texas for a few years and live in Florida for a few others years, or they get a job in a certain market and they want to go live there. So a lot of them want to have the convenience of a single family home, but be able to have the freedom of being in a rental community. So that's a little background about BTR SFR and type of people that live there.
How big are some of these communities? How many single family houses are in them?
So the sweet spot for us is around 60 to 100 units. That's a sweet spot for us as more of a boutique firm in a per community basis. But I've seen institution purchasing as large as 300 homes in these communities. The one that we're building in San Antonio, we're going through a process of naming these roads that are going to be in our community. So it's very interesting model. So we're very much involved in the process.
It's fascinating because it's like a multi-family unit building size with like the unit size, right? But it's single family and it's all in one community. How does it work with the upkeep and maintenance of this? If somebody's renting the house, like do the management company just take care of the common area kind of spaces? Is all the tenants responsible for their own yard and landscaping and all that kind of stuff?
Yeah, no, great question. When it comes to public areas, so the front yard or any kind of deficiency or anything breaking down, the property management managing the property takes care of it. Backyard is really on a per case situation. So the tenants are required to do their own backyard. That's not really the common area. The ones that we focus on, the 60 to 100 unit, does not have a amenity like the multifamily does, where there's a pool, community center, fitness area. These ones do not have that. So, and that reflects on, it's not the rents, the premium is not charged to the tenant. So they're not paying an extra amount for rent just because to have a pool and what have you, like it happens in most cases. But the larger ones, BTR communities, do have a community center, a pool, and that's all being managed by the property manager. So yeah, the common area, including the front yards and any deficiencies, managed by the property manager. Backyards is by the tenants, and the amenities obviously being managed by the property manager.
And then from a rental, a rate that you charge, obviously much different than the multifamily. There's obviously a premium to it so that you're living in your own house, single family house with a yard and, all the other things that goes along with it.
Believe it or not, the rents are very similar. Now the units are larger, so on a per square feet basis they're very similar. But just because the units are larger, the cost is a bit more. But yeah, I mean, the costs on a per square feet basis are very similar to multifamily.
And then obviously for investors, this is attractive, and that's why you guys were looking into it. Obviously, it's a huge trend that's accelerating, but the returns are pretty attractive.
Exactly. Yes. Yeah. So again, these deals, just like multifamily deals, built to rent deals, are syndicated as well. So investors can have exposure to these deals and get involved without actually owning and managing and going and getting debt or hiring property manager or contractors. They can invest with groups like us, CPI Capital, and have exposure to this asset class. Our business plan is usually a 3 to 5 year exit, depending on what the strategy is. But yeah.
It's interesting because I'm just thinking about it, like if you're investing in single family, right, and you've got like a turnkey rental portfolio, and I'm just trying to think from a risk management perspective. When you get to like 10, 15, 20, now you've got, a couple of doors to diversify, but that could take you years to get there. And then, with, let's just say you have 10, 15, 20. Now it's not just one, right? One door, one person doesn't pay. There's no income coming in. So you can kind of like manage risk by, having more doors. But with this, you invest into a deal where there is 60 to 100 doors already in a community. So that kind of that one risk of like building it one door at a time, I'm just thinking of, just where investors are at, but having a bigger access to a bigger deal like this, then that takes a little bit of risk off the table, right?
Absolutely. Yeah. The brain damage and the stress that goes into managing single family homes when it comes to management, tenants, bringing in tenants and so on could really be cumbersome. So yeah, there's a way for investors to have more of a passive approach in investing in the same exact asset class that they would have otherwise invested in.
Yeah, absolutely. So I always ask guests this when they share interesting ideas like this. How does this go wrong? Like, what are some of the risks that you need to manage in this particular strategy with BTR real estate communities?
Yeah, BTR, I mean, the risks that are associated with BTR are very similar to other asset classes in real estate. The concerns are the type of debt that the group is putting on the deal. So if you're putting a high octane debt, a bridge type of debt that there's an expiration for the interest rate kind of lock that's coming due, that could be problematic if the market slows down and the rates start increasing and now your term is over and you have to refi into a higher amount of debt. So debt is always a concern. On our deals, we usually put a fixed interest only type of debt for the term of the project. So if it's a 5-year term, we put a fixed interest rate type of loan on the deal. So that's something to always watch out for. Hyper supply is another concern. Oversupply, hypersupply. If you're buying in a market that does well, usually most people, most other investors also know the market is doing well, and that could create, hypersupply, oversupply in the market. You might have too much product coming online, and then you might have increase your vacancy. So that could be problematic. The other part is management. At the end of the day, groups like us or other investors, even buying a single family home, there's a lot of work that goes into finding the right property, doing the due diligence, doing the analysis. But the work really begins, funding the debt, funding the equity, but the work really begins when you're executing the business plan. So managing the property, bringing on the right property manager, bringing in the right general contractor to assist with any upgrades that are needed to be done or any upkeep. So that's another factor to look out for. Another factor is environmental factors, where it's obviously with Florida, with hurricanes. We had a hurricane that hit one of our properties in Florida, which is now we've been going through it for a few months. We finally got our insurance that paid out. So that's another aspect to look at. San Antonio, not really those concerns, but San Antonio does get hailstorms sometimes. So you got to make sure you have the right insurance on the properties and you're managing the process right with your insurance providers. Those are some overall risks. Is there a particular risk when it comes to BTR itself? I was listening to one of the chief economists with a large private equity firm here in Canada, and the question was posed to him about BTR, and his caveat about BTR was that when you buy multifamily is you buy a 200 unit apartment community. Even if it's garden style, they come in individual buildings. So you're dealing with 5 to 10 buildings, and each building has close to 20 units within the building. but there's only one roof, one siding, really, right? You're dealing with one roof. Whereas if you have a community of single family homes, you're dealing with a bunch of different roofs and a bunch of different sidings. So that could be a factor when it comes to CapEx. So there is an increased cost in CapEx, but when we buy these communities, we factor that in. So if you're factoring in a new roof or roof upkeep, we factor that into our underwriting. So we bake it into our prices. So that's something else that I heard somebody experienced bring up. But if you know what you're doing, you're factoring those costs in.
Yeah. Very, very interesting. What and a question on security. Is there security too for those communities, or most of them gated?
It could be gated. The one that we're building in San Antonio is not gated, but yeah, some of them are totally gated communities. The larger ones that we discussed, that they have their own amenity centers. I guess if you have a pool, you don't want people just driving in, jumping in your pool. But yeah, the ones that we're building, there's no, they're not gated.
Gotcha. Because in Florida, you've got a ton of these gated communities too. Especially Florida is very well known for them.
Exactly.
Because again, they have access to pools. They've got a pool club. Everybody on. They have beach access. So there's a whole bunch of other reasons why too. But obviously, security being one of it, and protecting the space for the people that live there, right?
Of course.
Yeah, this has been fascinating. Let's change gears here for a second. One question I always ask my first-time guests, because we talk about business, we talk about investing, we talk about cash flow, and yields and returns and profits, but we also talk a little bit about legacy and leaving a legacy to future generations. So I always ask my first-time guests, if you cannot pass on any money to future generations, and you are only allowed to pass on 3 principles or values to them to help them achieve happiness and success and build wealth, what would they be?
Happy, success, and build wealth. Wow, that's a lot of big stuff there
I
to
left it
pass
wide
on.
open.
Yeah, no, I've actually, I have, me and my wife had just our second son join us a few months ago. So he's 4 months old
Congrats.
now. And our first son, he is a year and a half. So they were back to back. They're 13 months apart. And yeah, that's something I think about on a daily basis. Actually, what we've done is we've made a decision internally with CPI that we're planning to name all of our multifamily properties Atlas. So the property we close in Tampa is called Atlas at Bay Point, named after my firstborn. And then all our BTR properties are going to be named Apollo. That's my second son. So our property in Apollo Oaks in San Antonio is named after him. And that's more, not only assisting them with something for them when they grow up, something named, a community named after them, but is also for us internally as well. If a name of a family member is on the property, it allows us to have more pride and be more cautious and be more vigilant for the deals because the name of our family is on it. So that's something interesting I wanted to share there. But
Great.
yeah, for my sons, I think about it all the time as far as the knowledge. One thing about education that I want to say with my sons, and I think there's a bit of fallacy these days. There's a lot of information and material coming out that you don't need education, you don't need formal education. I agree with that in some sense, but the advice that I would give is that education makes it a lot easier, because it's not only the fact that you're going into these institutions and learning, going into Ivy League schools, where I want my sons to go. Unfortunately, I never got a chance to go to Ivy League schools, but I would love for my sons to go to Ivy League schools one day, is the type of people you meet, and the lifestyle that those people live, and the type of parents they have, and the way they view life. Some of the greatest experiences I've ever had learned in life was from somebody's viewpoint about life, about
Yeah.
simple things. So being in these institutions, being around these people really helps with that. So this idea of, you don't need school to be successful, I agree with that in some sense, but I think it's a bit of a fallacy. I think it's important to go into the right institution and learn and type of people you're going to have. Financial literacy is another very important part. Learning about how finances work, learning about contracts. I think these days most people don't read stuff. It's important to read and familiarize yourself, gain some level of financial literacy. And with so much information online these days with ChatGPT, I mean, I just use ChatGPT an audible version. I'm just asking questions from it all day, and it responds to me in audio all day long. So there's no excuse really for not learning about financial literacy, about different strategies. I mean, I never knew about, I knew what life insurance was, but I never knew you could use life insurance as a strategy to double dip your money and all these things that crafty billionaires use, whole life and other kind of strategies. So there's so many things that I thought I knew everything about real estate or investing that I've learned over the last 5 years. So financial literacy would be the second thing. And third thing is really, understanding that your body is a temple. Like Warren Buffett, our good friend, says that you only get one body,
That's right.
That's all you get in this lifetime. So understanding your body is a temple, a great mind always operates in a great body. So taking care of yourself, always, making gym a culture. Like in our house with me and my wife, since we got married 5 years ago, we go to the gym every day. So it's not about going weekdays or 5 days, it's every single day, because no matter what, you miss a day here or there. So if you plan for 5 days a week, you're going to end up going 3 because you missed a couple of days. So our culture is we go to the gym every day. So it's something that we go on a daily basis. Do cardio, be active. There's so much incredible things to do these days, to get outside, do fun things, take care of your body, eating good food. So longevity, in a sense of serving for others as well. It's not just longevity in a selfish way, but to be able to serve and do good for others. So those are kind of the 3 pillars, I would say.
Where can folks follow you? Where can they connect with you and interact? And where can they stay informed of all the many projects that you're involved with?
Absolutely. I'm very active on LinkedIn. I think LinkedIn is the social media for business people. So August Biniaz on LinkedIn. I'm a LinkedIn top voice, invitation only. So I have to kind of boast and brag a bit about that. But I'm there very active on LinkedIn. You'll probably see the copy, this episode on LinkedIn being advertised. So you might have ended up coming to this show from my LinkedIn page, but I have, I think now over 20,000 connections. So yeah, LinkedIn would be the best place to connect with me, and send me a message saying you saw me on this show. And I love to, be able to, give you some time. So yeah, as long as you tell me that you've seen me on the show, I'm happy to provide some time.
Awesome. Well, August, this has been fantastic. It's been a pleasure to connect with you, and really enjoyed our discussion. Thank you for coming on the show and providing so much value for all of my listeners and my viewers.
Of course, my pleasure.
And thank you to all of my listeners and my viewers for again spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. We've got over 1,000 podcast episodes. We have 4 books. We have reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the best newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.